Happy to welcome you to another market update, where we will take a quick look at what's happened over the last year, why it happened, and what opportunities we see on the horizon. Will the market recover this year? Is a recession at our doorstep? Can you win by losing less? And are bonds truly back? Let's dive right into it. First, let's start with a quick review of what happened. The markets witnessed a prolonged period of difficulty throughout the year last year into this year. It's worth noting that the market experiences a downturn every 4 to 5 years, and last year was no exception. However, what made it particularly unsettling was that both the stock and bond markets plummeted, making it the most unfavorable year for equities since 2008 and the worst year for bonds in 75 years. The S&P sank to a low of around 25% and finished the year down almost 20%, while the NASDAQ hit its bottom at minus 35%. So the big question is, why did it happen? The market decline can be contributed to two major factors: inflation and interest rate increases. Inflation is a critical issue that needs prompt attention, as it can have long-lasting detrimental effects. Inflation is like a disease that the longer it stays in your body, the more damage it does. To tackle inflation, the Federal Reserve decided to raise interest rates. However, this abrupt rise in rates caused negative reactions in the stock and bond markets. The Federal Reserve increased rates by 4.5% last year and is continuing to do so. This was the fastest rise in interest rates in the history of the United States. As a result, all asset classes lost money last year. The stock market has always been a leading indicator of the future state of the economy. It usually moves a year or two ahead of what's coming, like a financial crystal ball. Since the market has dropped, it's likely that the economy will struggle over the next year or two. But remember, as this is important, the stock market and the economy are two distinct entities. Now to the good stuff. What are we likely to see next? You may remember that we focus on what's called market cycle sector rotation. Right now, we are still firmly in the late stage of the market cycle and getting really close to, if not already in, the recession stage. This is generally when the waters are the choppiest. The Fed will likely continue to raise rates until inflation cools. Then they will pause and start cutting again to spur growth. On average, this lag lasts 10 months or so. So what are we looking for going forward? Interestingly, when consumer sentiment bottoms out like it did in December, the average 12-month return of the S&P 500 following that is plus 24.9%. So you're probably asking yourself, well, Seth, what should I do? The solution, in our opinion, is focus on asset allocation. First, check to make sure you're working with your advisor to strategically adjust your portfolios like we have done for our clients. Don't let your retirement accounts sit around with its hand in its pockets. Does that mean that you should sell your stocks and wait until the bad news ends? Survey says, absolutely not. And by survey, we mean history and data. The average market return over the last 20 years is 9.8%. Missing just the best 10 total days over those 20 years drops the annual return to 5.6%. Timing these moves is next to impossible and honestly irresponsible. Warren Buffett once said, "The stock market is a device to transfer money from the impatient to the patient." In tough markets, you win by losing less. With that, let's take a sneak peek and see what opportunities are on the horizon. What's that in the distance? Can it be? Yes, bonds are back, and we're not talking about the Thin Lizzy song. Bonds have never, in history, lost money 3 years in a row, like they did. They were negative in 2021 and 2022. And that's only the third time since 1926 that bonds have had back-to-back losses. And now, they're coming back with a vengeance. Money market accounts are paying over 4%, 3-year CDs and short-term bonds are over 5%. We see a path where bonds are going to outperform stocks this year. We foresee that you will be able to clip interest rate coupons of 4 to 6% for fairly safe bonds that stretch out over the next few years. Plus, while interest rates are still rising, bonds sell at a discount. Once the end of the Fed rate hike schedule becomes clear, you will see that bonds rise in value. giving you a return from both the coupon and the appreciation. It's possible that we could see double-digit returns in some bonds over the next 12 months. Yes, we also think that equities may continue to struggle. They will ride the waves of the great days and the terrible days. That's why we feel one of the best places to be in times like this is to invest into dividend-paying stocks. It allows you to receive the dividend and get some return while you're riding the ups and the downs of the market. We also still leaning into sectors that do best in economic downturns, including consumer staples and healthcare. We also still favor tactical positions in agricultural technology. Thank you for spending a few minutes with us to outline what we witnessed the last year and what we see in the future. We hope that it keeps you knowledgeable about what's going on and provides you with confidence on what to expect next. Rest assured, you can always rely on us to protect and grow your hard-earned savings. As always, stay strong, stay smart. Until next time.